Hi everybody, I'm Steve McDonald and this is your Investors Daily Edge midweek market update. In focus today, trends we know will make money, decoupling from the euro, hard assets and inflation/deflation, economic reports this week, a play on one of the best companies in the country, and the biggest risk in the market right now. The markets right now are being driven by one thing, the euro. This while the US and the emerging world are right on track for a great recovery. The solid numbers are being ignored by the markets and the whole focus is on one thing, the euro. Two things are going to happen in the near future. First, the markets will refocus on the very good economic numbers from the rest of the world minus Europe. Yes, Europe will slow down the recovery for the rest of the world as it cleans house, but most of the developed and emerging worlds are recovering very nicely. And the second thing that will happen is the market will decouple from the news about the euro. The focus will then be on the good economic news in the rest of the world. The current market volatility driven by the euro is a buying opportunity and is one of the trends we know will make money for you. And we are recommending you look at it today. Look for bad days in the market to increase your positions and look for badly beaten up stocks from the S&P 100. Buy them while they're cheap. Our next topic, hard assets, oil, gold, copper, lumber, just about anything industry and construction use to build and produce goods. Inflation is always good for the prices of hard assets. But many pundits have been poo-pooing the idea that we could have inflation in this environment. I have to disagree. Yes, there is a lot of slack in the system from the extended recession, which leads to most of the deflation talk. But the amount of liquidity being pumped into the system, and this is money being printed by the central banks, will suck that up much faster than anybody is betting on right now. This inflation pop I'm expecting, in addition to the already robust demand for raw materials, namely commodities, the demand from the recovering portion of the world will drive hard asset prices a lot more than expected. Take a look at natural gas also. Again, I know I've recommended this before. Another big multinational oil company just dropped about $4 billion on natural gas reserves in the Marcellus Shale region in the northeast United States. Remember, ExxonMobil did the same thing not too long ago, buying up a natural gas company. Rusty McDougall was on the program a week or so ago and told you then that gold was on sale that week. I think gold was down in the 1150 to 1170 range. We've seen a nice recovery since then, and Andy Gordon also made a very good case for copper on last Friday's program. Both are still in buy ranges, especially copper, and they both look to have a lot of upside near term. Don't miss this commodity run. It'll take a little while to develop fully, but it's another of the trends we know will make money. Take a look at molybdenum, too. I didn't think I'd be able to say that word, molybdenum. This is associated with the unavoidable increase in demand for steel as the recovery worldwide continues. Again, minus Europe. Next up, lots of economic reports this week. We've already seen construction reported, and it was one of the best numbers in decades. Also, manufacturing was down slightly, but better than expected, and the market liked both of them. Remember, the market was off about 150 points in pre-market activity on Tuesday morning until these numbers were announced. Now, the rest of the week will have 5 major numbers, including unemployment. It looks like it could drop a little, but maybe 0.1%. But most of this drop is due to the temporary jobs created by the census. Next, a slap in the face investment. This isn't the award, this is an investment. And I call a slap in the face investment as one that's so obvious to me that it's really just like a slap in the face. The oil spill seems to just be getting worse and worse, but one company has really been beaten up, and too much, in my opinion. And it's just too diversified and has too much going on to be as low as it is right now. Halliburton, symbol HAL. This is one of the key companies in the world in development and production of energy, and by all accounts is not responsible for the mess in the Gulf. It's still a little early, but all fingers are pointing towards BP as the one that had the final say about how things were done on that rig. I have a little bit more to say about that later in this segment. Now, even if Halliburton is partially responsible, it's been too beaten up to date over this. It's down to around 22, down from 35, and it was down as much as 12% on Tuesday. That's too much. It could drop a little further, but this is worth watching. 18 is its 52-week low. Put it on your screen in front of you. Keep an eye on this. If this thing starts to kiss 18, I'd be a buyer. The biggest risk in the market right now, and it's not the stock market, it's interest rate risk. This is a little known and less understood value, and it stands to cost a lot of people a lot of money in the near future, and most of these people who are going to lose here can't afford to. Here's how it works. The recent flight to safety during this big sell-off, namely to Treasury bonds, U.S. Treasury bonds, happened at historically low interest rates. Think about it. The short rates are still near zero, and the 30-year is just paying a little over 4. That means when the rates turn around, and they will, you'll be stuck with a low-yielding bond that will drop in price as interest rates move up. Buying long maturity bonds in this market thinking you're locking in a secure return will be the next disaster. I've said it before, avoid treasuries here. It will end up costing you money. Look instead at short-term corporate bonds, short-term, average of 3 years, in the BB to BBB quality range. That's going to give you somewhere around an 8 to 10% return, maybe more. And that's about the only way I know to survive the next trend, which will be higher interest rates and lower bond prices. This is the way you make money on that trend. Finally, the slap in the face award. You knew it had to come to this. BP's getting it, and something called the Mineral Management Service of the Interior Department. I'd never heard of the Mineral Management Service until I read the Wall Street Journal today. It seems BP submitted multiple requests to modify their drilling platform operations in the days preceding the explosion that caused this mess. All of the changes were designed to decrease its operating costs from what has been described as the gold standard by experts in the industry, and instead go with cheaper methods. And if that isn't enough, according to the Wall Street Journal, the Minerals Management Service, a division of the Interior Department that's responsible for reviewing and approving the changes, approved some of these changes in as little as 5 minutes. They had all the times and dates in the journal. It was amazing. Well, it's nice to know the changes were given a thorough review before they were approved. 5 minutes to approve a change like that. That's unbelievable. That's about it for today. Look for the Friday video. I'm going to be starting a new segment on the Friday video where I'm going to list stocks recommended by analysts and brokers who I know in the industry. It's going to be kind of like an IDE list to follow. What I'd really like to see is how good are these guys at their predictions. Also, from our IDE analysts, more trends that we know will make money. We'll see you then.